What to do about the new capital gains tax in Canada, or how can life insurance help Canadians with the new capital gains changes? There's been some changes recently to the capital gains that was first introduced in the 2024 Canadian federal budget. It's been official for a couple of months now, and it's live. These changes have made selling anything for a capital gain a lot more expensive now, but life insurance can help. Hi, I'm Laurent Munier, and welcome back if you've been here before, and welcome if this is your first time. So what is the capital gains inclusion rate? Just so we're on the same page, the Canadian government defines a capital gain as when you sell or are considered to have sold a capital property for more than the total of its adjusted cost base and the outlays and expenses incurred to sell the property. Basically, you bought something for price A and then you sold it for a higher price B. Whatever that increase is, that's called a capital gain, minus whatever expenses it took you to get there. So the part that's changed is how much of this gain is taxed. It used to be that 50% of that was taxed. Now, with the new capital gain inclusion, 66% is included to be taxed. That's the inclusion part. So if you're doing this personally, any gains below $250,000 are taxed at the old inclusion rate of 50%, and then anything above $250,000 is taxed at 66%. You'll pay whatever your marginal tax rate is on that 66% of the gain. If you're investing inside a corporation, the whole amount is at the 66% inclusion, and there is no lower number. The government says you are a really bad person for making all this money and all of the problems in the world are your fault, so they're gonna take more of your money and spend it better than you can do. That is basically what they told us when they changed this inclusion rate. So how did we get sold this change? Well, the government sold this change by saying that this new higher capital gains inclusion will only affect 0.13% of people per year. Now, is this true? Sort of, but only if you exactly fit the scenario that they use to sell the tax increase. If anything changes, or if you zoom out, it doesn't work. So what they're selling you is that this only affects 0.13% of Canadians, or 44,000 people a year, which is sort of true. Most Canadians who would have this large a capital gain, more than $250,000, will only have this maybe once or twice in their lifetime. It'll probably be on death or maybe selling a secondary property. Most people wouldn't have this large a capital gain every single year unless they were very rich or a genius investor. So that's where the government kind of does their sleight of hand, because they say people won't be affected by this every single year. No, but you will probably be affected by this once or twice in your life. So yes, it'll affect 44,000 Canadians this year, but it'll affect a different 44,000 Canadians next year and a different 44,000 people in the following year, as each of these cohorts has this windfall that the government wants a bigger piece of. So right now, the baby boomer generation are mostly retired, and some of them are starting to pass away. So this could be your parents or people that you know. When they pass away, their estate is going to have to file their terminal tax return, which is probably the largest tax return that they will ever have filed in their lives. This includes the value of the house, the full value of their RRSPs or any other investments, any businesses, anything that they ever owned, taxes due now. So this quickly adds up to a lot of people. And this is that 0.13% of people that the government is trying to convince you that it only affects. So your inheritance that your parents thought that they were giving to you, well, now more of that is probably going to go to Ottawa because your parents were bad, greedy, rich people who should pay more money to the government. And they shouldn't give it to you because the government knows how to spend it better than you do. So what role does life insurance play in mitigating the new capital gains inclusion rate? So if you want to make sure that your legacy or that your parents' legacy goes to the next generation, to you or to your kids, well, you can buy life insurance now with the goal of that death benefit paying the terminal taxes on the assets, on the business, on the property, so that all of these can transfer to the next generation if you want to keep them in the family, right? If there's no liquidity in the estate, or if the children at that time don't have money, some of the assets might have to be sold to pay the taxes. So now that sounds simple, but what if the market is down when you're forced to sell? What if it's real estate and the market is soft? It would be better to keep the property than to have to try to sell it now. Also, we're talking about all of these things Your parents have just died. Is selling a house the number one thing on your mind and the number one thing you want to be doing? No, you probably have other things that you want to deal with when your parents just died. If your parents owned, say, like an apartment building and they bought it for tens of thousands or hundreds of thousands of dollars in the 1980s or 1990s, it could be worth millions of dollars now. And you are going to get slapped with a huge capital gains bill if you want to keep that building and it transfers to you. If they owned a business and it's passed down to you, well, there's taxes payable on the growth of that business. This is something that you're going to need a lot of coverage for. And you need to work with somebody who can help you to figure out how much you or your children are going to need in the future to pay these taxes if you want to keep these assets in the family. This is where you want to work with a professional. You'll need someone to do the insurance for you, so you need a good advisor. That's probably us here at Safe Pacific. You'll also need a good accounting team. And if you want to make a plan, you'll need a good estate planning lawyer to write all this up. If you don't have these people, we can introduce you. Contact us through the website and we'll make introductions. On the insurance front, we're estimating your future tax liability, while at the same time, we don't know some important facts like how many years until your parents or grandparents or you pass away. We don't know. What are taxes going to be at that time? And then what's the value of that asset going to be at that time? These are all really important numbers that we don't know and there's no way to know right now. So what we can do is we can get close and we can estimate. And an estimate is better than nothing. So let's say that we make this plan and we say, okay, well, we can estimate that the taxes due in the future for your kids is going to be around $600,000. But then we're off by a little bit and the taxes due are going to be $650,000. Well, with the insurance estimate, you're short about 50 grand, which is a lot easier to come up with than 650 grand, right? So it's better to have the insurance pay out most of it and then you cover the rest. If you own a business, if you own real estate, if you own a cottage or a vacation property, and if you want your kids to be able to cover the tax price tag without selling, then come and talk to us because you're probably going to need some insurance and you're going to need an estate plan on how to transfer that without losing it. The best way to get a hold of us is through our website at safepacific.com. Send us a message. One of us is going to get back to you within 24 hours on business days, and we'll schedule a meeting to take next steps. So now, if you gain value from this, can I ask a favor? Please do all the things that the robots like. So that means like, comment, subscribe, share to other people like you so the algorithms will surface this video to them, right? Other people who own businesses, who have investments, who maybe own a secondary property, and people who generally care about their kids, who care about their parents, and who want the family legacy to continue. Those are the people that we're trying to reach, and when you share this helps get it to them. So that's it for today. I will see you next time.